Welcome to another Generate Investment Update. This morning I'm sitting here with Andrew Bolland from our investment team and he's going to give us an update as to what happened in November. Andy, tell us about the markets in November.
Good morning, Liz. So it was perhaps as expected. We've had declining consumer business and investor sentiment over the course of the year. We recently had Freightways, which is a national logistics company, provide commentary around they're seeing declining business volumes both in the consumer and business components of their business, and they're seeing that both in New Zealand and Australia. We also recently had Black Friday sales, which are down 10% on the prior period last year, and that's interesting in the context of the degree of inflation that we've had through that period. So if we adjusted for that inflation, the actual sales number might be meaningfully less. We had 3 of the 4 listed retirement village operators report over the period, and they all called out the uncertainty in the housing market that's persisting and actually causing them to experience some slower than expected sales across both their new and existing retirement village products. And they also think some of that uncertainty might persist into 2024. And then you've got some businesses that have got exposure to the China economy, and they're calling out that things are actually pretty difficult. So Comvita is a good example of that, and they sell Manuka honey-based products. And they recently commented that sales for them are down 10% for the first 4 months of their financial year. But it's sort of interesting against the backdrop of all of that, the market was actually up 5.3% over the month of November, and that sort of suggests that while we've had some softer results across the board, that it was to some extent well anticipated.
Was this kind of consistent across the board, or were there any companies that kind of produced a different result?
So there were a couple of standouts. Mainfreight is one of those, and they're a global logistics provider. They actually called out that September for them was quite a positive month relative to the September of last year, and it actually gave them enough confidence to think that they might be at a trough in terms of the current economic cycle that they're facing. And that strong September, it actually flowed into October as well. So that was pretty interesting. And then Goodman Industrial Property Trust, they also called out strong demand for rental space across their Auckland portfolio, and to the extent that they've actually got a 0% vacancy rate. And so between those two things, they're actually seeing strong rental growth tailwinds, which is quite a positive dynamic.
One of the larger companies on the NZX to report was Fisher&Paykel Healthcare. How did they fare? Yeah,
so Fisher&Paykel Healthcare had quite a solid result, and especially in their home care division. Now that's pretty interesting because there was some market concern that GLP-1s was going to impact the home care division. Now what I mean by that is that GLP-1s are a new weight loss drug that's sort of becoming increasingly available to the broader population. So what Fisher&Paykel Healthcare sells via their home care division is the treatment for something called sleep apnea. And sleep apnea is strongly correlated with obesity. And so the market concern was that as weight loss drugs are more widely available to the population, rates of obesity might decrease, and in turn rates of sleep apnea might decrease, and therefore the growth rates that might be available in Fisher&Paykel's home care division would reduce. So we haven't seen that to date. It is early days, but it was a strong result in that respect. They've also released some new products, one in the aesthesia hospital segment, and also an evolution of their hospital oxygen humidifier product, which is Evo 3. So we're coming off a pretty low base with those products, but they are seeing quite strong traction in early days, so that's great. I mean, ultimately for us, Fisher&Paykel has an extremely full valuation, and what that means is they really need to execute their strategy almost flawlessly over the next few years. And so that just really gives us pause at the moment in terms of the attractiveness of Fisher&Paykel as an investment today.
Oh, that's very interesting. What about Infidel?
So Infidel, as you might know, is one of the core portfolio holdings in our Australasian portfolio, and they also produced a pretty strong result. So 3 of their key assets performed pretty well over the period. The first being RBNZ, which is formerly Vodafone New Zealand. They're demonstrating stronger ARPU, which is average revenue per user. They're gaining market share across the mobile division of that business, and they're doing a really great job in terms of cost control. And so that's contributing to increasing profitability in that business. And then Canberra Data Centres, or CDC, they're experiencing very strong demand for data centre space and development, some of which has been driven by artificial intelligence tailwinds. So they've actually doubled the development pipeline that they've got in place, and will look to build that out over the next few years. And that's leading to them now thinking that earnings growth might be in the range of 30 to 35% in the future, and that's up from a range of 20 to 30% that they'd talked to prior to that, so pretty strong. And then lastly, the Infidel US renewable energy business, Longroad, that's seeing really strong tailwinds from President Biden's Inflation Reduction Act program, and that program is really about kickstarting the US on the renewable energy transition that the country needs to go through. And it sort of looks to subsidise and incentivise developments in that space, and at the same time having a Made in America component to it. And so Infidel's Longroad is really in a good position for that sort of setup.
Are we likely to see corporate activity in local markets? Ebos was a bit of a big non-deal.
It was. So Ebos was pretty interesting last week. Ebos is a large company listed on the NZX, and they've historically grown through small, medium and large acquisitions through time. So what they did is they came to the market and were hoping to acquire a company called Green Cross in Australia. Green Cross is a large specialty pet retail business and also has a veterinary services component to the business. It was a very large transaction, so Ebos in its current form today is predominantly a pharmaceutical distribution business, and so adding in the Green Cross was going to fundamentally change the composition of Ebos's earnings. And as I say, it was a pretty large deal, as they were looking to raise to the tune of around $2 billion of new equity from local and Australian equity capital markets. And ultimately that deal didn't proceed for a number of reasons, but one of the read-throughs that we can take from that is that the mood of capital markets right now is somewhat subdued, and so we expect we might see more capital activity through into 2024, but it's going to need to be at the right price and in the right spaces.
And finally, we had the last MPS statement for the year out from the Reserve Bank recently. What happened there?
So they held the official cash rate at 5.5%, and that part of it was universally expected, so no surprises. But what was interesting was some of the commentary that was around that interest rate decision and the forward interest rate track that the Reserve Bank talked to. And so we'd describe that as being hawkish, and by hawkish we mean sort of risk to the upside on interest rates, as opposed to dovish, which is risk to the downside on interest rates. So there are a number of contributing factors to that, but the government called out two in particular really, and one was we've had a large degree of net immigration into New Zealand over the course of the year, and over that time the Reserve Bank's come to the conclusion that actually the aggregate demand from that large amount of net immigration we've had in might actually have an inflationary pulse that's yet to sort of flow through the economy, and that's basically from more people buying more goods and services in New Zealand. And the other one is that the labour market still is quite tight. While the unemployment rate has ticked up to around 3.9%, historically that's still a pretty low rate, and typically when you to get inflation under control, you do need to have a greater degree of loosening in the labour markets.
Great. Thanks so much for joining us this morning, Andy.
Pleasure.
If you have any questions, drop them below and we'll be sure to answer them. Thanks.